All eyes are on US non-farm payrolls tonight. Australian households spend plenty going to Taylor Swift concerts. Building approvals weaken on both sides of the Tasman. And Kiwi house values track sideways. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Commodities strategist Soni Kumari looks at why you paid so much more for your Easter eggs this year. The cocoa price has been soaring.
Ivory Coast and Ghana cocoa arrivals, which is proxy of supply, are still down by 30% against last year. And since there is no sign of easing supply tightness, this is keeping prices elevated.
But first in 5 and 5 with ANZ. All eyes are on tonight's US non-farm payrolls figures in featureless trade on global markets this morning. US bond yields were flat, taking some wind out of the US dollar sales, and that meant the Aussie dollar is up 0.8% at 66.15 US cents at 5 a.m. Sydney, Melbourne time. The Kiwi up 0.6% at 60.46 US cents. US stocks are up around 0.5%, with strong techs a factor there. The consensus for US jobs growth in March is for a fall in the growth to 200,000 from 275,000 in February. ANZ head of G3 Economics, Brian Martin, says it will take quite a miss to rumble markets too much.
I think for the markets to get anxious about the Fed not cutting interest rates, we'd want to get a really, really strong labour market report for March. And for me, that means you'd probably need to see, given that there are big revisions every month and that there are realms of statistical flex within this. I think you need to see a number in excess of 350,000 to really dent market expectations that the Fed will be cutting in the second half of this year.
Number 2, spending by Australian households was up 3.6% in February from a year ago. ANZ economist Maddie Dunk says that was led by non-discretionary spending, although a big player in the month was the Taylor Swift effect.
Had about 600,000 Swifties attending 7 concerts in Melbourne and Sydney during February, and that has flowed through to the household spending indicator. We've seen a rise in spending on hotels and on dining and takeaway, also on transport. Now, some of that transport lift might be partly due to higher fuel prices, and anyone that's had to pay for petrol recently would attest that fuel prices are very high at the moment.
Number 3, Australian building approvals unexpectedly fell in February, down 1.9% from January and down nearly 6% over the year. Maddie says approvals are near decade lows.
It reflects a number of things, the current constraints that we're seeing in the construction sector, also the fact that rate hikes have hurt investor appetite, and we saw in the release that unit approvals were down almost 25% in February, so a bit of weakness there, perhaps alluding to some softness in investor appetite.
Number 4, in New Zealand, consents for new dwellings were also down 6% in February from a year ago. ANZ senior economist Miles Workman says dwelling construction is one of the most interest rate sensitive parts of the economy. And while this indicates monetary policy is working, New Zealand needs to build more houses.
New Zealand issued 36,000 consents or so in the year to February, which is well down from the 50,000 plus peak that we were recording back in 2022. And, from a momentum perspective, that still looks like it's got a little bit further to travel in terms of coming off those peaks. I think the big picture here is we're still not building enough houses to keep up with demand, given very strong migration-induced population growth.
Number 5. New Zealand house prices, though, are tracking sideways. CoreLogic data shows the average New Zealand house value was up 0.1% in February from a year ago. Miles says the outlook isn't too flash for house prices over the next year.
The number of days it's taking to sell a house, for example, that's on the rise, and we are seeing more properties available for sale in the market, which ultimately means more options for buyers and isn't a very positive signal for prices. So lots and lots of moving parts to digest and to factor into our forecast. And our forecast is for a relatively modest rise in prices over 2024, so just 3% up this year is our forecast.
Miles Workman there. Now, in today's bonus deep dive interview, ANZ Commodities strategist Soni Kumari explains what has caused the global cocoa price to shoot up in recent months.
This is a supply-driven rally, I would say, and there were a series of production downgrades in major producing countries like Ivory Coast and Ghana. And these two countries together alone produce 60% of global cocoa production. So first, it was dry weather condition induced by El Nino, and which impacted the productivity of trees. And further, the production losses were worsened by swollen shoot virus disease. So overall, we see nearly 400 to 500,000 tons of production loss in these two countries. And this brings to nearly 8% year-on-year drop in global cocoa production this year, which leaves the market undersupplied by more than 400,000 tons, which accounts for nearly 8% of annual cocoa consumption. And so far, weather has not turned favorable for the crop. And Ivory Coast and Ghana cocoa arrivals, which is proxy of supply, are still down by 30% against last year. And since there is no sign of easing supply tightness, this is keeping prices elevated.
And how is this different from previous price spikes in the cocoa price?
So in this upturn cycle, the market deficit is a bit stretched because now in 23 and 24, this is the third consecutive year of undersupplied market backdrop. And for next year as well, we are not seeing a very strong recovery in market balance. Market balance is likely to remain negative if we don't see a significant drop in cocoa demand for 24 and 25. So that's how it is looking like. Prices are likely to stay high because the market balance is not likely to recover soon.
So we're also seeing price volatility from a shift to more sustainable farming practices. Could you tell us a bit more about that?
Yes, so cocoa farming is normally associated with deforestation. So just to give you some numbers, according to a study, nearly 70% of forest loss in Ghana and Ivory Coast over the last 30 years is partly associated with cocoa farming. And although the deforestation rate has slowed, some of the Ivory Coast cocoa farms are still in forest protected area. So while ESG compliance for cocoa plantation area is a structural story, the recent European regulation on deforestation-free products is impacting cocoa buying at the time when supply is lower. So US has set to implement this regulation by end of this year. And this is leading to restocking by European chocolate processor ahead of implementation of this regulation. And this is also creating a kind of supply tightness in the market at the moment.
So how long are these high prices going to last? And what might we need to see prices correct back?
So this remains a momentum-driven market right now. We think prices are already at lofty levels and should start correcting if weather turns favorable in Africa and Asia. And market is closely looking at mid-year crop for Ivory Coast and Ghana. So if we see some kind of positive outlook for cocoa crop for the coming months, it's likely to weigh on prices. While on demand side, market will be closely watching cocoa grinding number for Q1 because the prices were already high from January, and this will have some impact on demand as well.
Soni Kumari there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, April the 5th. Catch you next week with reaction to those all-important US non-farm payroll numbers. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.